Hey guys, Dave Keller here with Market Misbehavior. Moving averages are a common way that technical analysts can smooth out the price data over time and focus on the longer term trends, although there are a number of different settings that are often used for moving averages. The most commonly used settings are the 50 and the 200-day simple moving averages. On a recent video on this channel, I was asked, which is better, the 50-day or the 200-day? Today we will dig into those moving average settings, look at what sort of information they can tell us about a particular set of charts, and answer that question, which is better, the 50-day or the 200-day moving average? So moving averages are a commonly used part of the technical analysis toolkit. The most commonly used settings are the 50 and 200-day moving averages. If you ask me which is better between the two, the short answer is, it depends. The long answer we'll get to here in a moment, but if you've liked this sort of thinking about technical analysis, investor decision-making and behavior, breadth, sentiment, trend, momentum, all those things, I hope you'll subscribe to my channel. It'd be great to have you along this ride with us. Also, give the video a like. If you appreciate it, we'd very much appreciate that back. Put a comment below. What do you think about these charts that I'm about to show you? Bullish? Bearish? Why? Let me know in the comments below. Let's look at some charts. So the short answer to that question is it depends, right? In terms of which is better, the 50 or the 200-day, because I would tell you, they actually tell you very different things about the overall market. Now, both of them are designed to smooth out price data, right? To smooth out a data series over time. Day-to-day price action of any asset class, but particularly equities, are fairly noisy, right? Because every day you have up during a trend, you have up days and down days, and overall that nets out to a longer term trend. But day-to-day movements can often be super fluid. I often call it the flickering ticks of the market. So moving averages allowed us to sort of step back from the noise of the day-to-day price action, focus on the longer term trends. Most of my charts are going to look very similar to this one. So let's orient ourselves very quickly to what we're looking at. We're looking at a daily open, high, low, close, and this chart is DVN, Devon Energy in the energy sector. We have the daily open, high, low, close, the 50-day moving average in blue, the 200-day moving average in red. I'm pretty sure all of the charts I'm going to show you use those same color coding, so it should be easy to remember which is which. Now below, we have things like RSI measuring price momentum, relative strength, which looks at this stock versus the S&P 500. We won't talk a lot about those, although in a lot of my other videos, we focus on those as measures of momentum and relative strength. But here we have the price, the 50-day and the 200-day. So let's talk about how we actually use these indicators. A couple different things. Number one, where is the price relative to the moving averages? A bullish trend is the price is at the top and then the moving average is below. A bearish trend, very simplistically, is the price at the bottom and the moving average is above there. So something like DVN and a fairly consistent uptrend, you have price first, then the 50-day, then the 200-day. And that's overall what a chart in an overall bullish trend is most likely going to look like. Think about the sectors right now. You have something like the XLE above two moving averages. You have something like the XLC, right? Communication services below the two moving averages. Now, what else can we do? We can also look at the slope of the moving averages. Are the moving averages sloping higher or lower, right? So a bullish trend, the 50 and 200-day are sloping higher, price at the top. A downtrend, the 50 and 200 would be sloping lower. So we can look at the change in those moving averages over time. We can also look at where the price is and when it finds support or resistance, where it trades around those moving averages. This is where I want to get to when I think about what's better, the 50 or the 200-day. The 50-day moving average is a commonly used measure of short-term pullbacks, what we call a tactical pullback within a longer-term uptrend. Sort of the sweet spot for a lot of institutional investors are stocks that are in long-term uptrends, but are showing some short-term weakness, right? So overall, the trend is positive, but pulling back a little bit. And often looking for a pullback to the 50-day or the 10-week moving average is often a pretty decent measure. So look at when DVN actually rallied and made a new swing high in the fourth quarter of 2020. You then see this fairly consistent pattern of higher highs and higher lows. Look at how often that the price pulls back to its ascending 50-day moving average, and more often than not, ends up being a pretty decent entry point to sort of leg into that price or to buy on the dips and ride the price trend higher and higher. Now, there was one period here in the summer of 2021 where the 50-day moving average was broken. That's where you have to be a little bit more skeptical, a little more critical, and determine whether or not you feel like this is enough of a pullback to get out of a long position or to question the uptrend at the very least. The end, of course, a number of things told you that the trend was reverting back to a positive trend. We got back above the 50-day. We made a new high there in September of 2021. And of course, it's continued on over the next 8 or 9 months, making higher highs and higher lows, often pulling back to the 50-day, often being a decent place to leg in. So with a chart like this, the way you use a 50-day moving average is basically expect or anticipate pullbacks that hit the 50-day moving average to sort of find support around that area. That's a great opportunity potentially to buy on the dips and push the price higher. So what about the 200-day moving average? Well, if we bring up a little more history, now we're looking back about 5 years, you can see that I was focusing before on this last 2-year period, but if you go longer term, we get a little more different cycles, right? We have bear cycles and bull cycles and different things. You can see that the configurations of these moving averages actually change. I'd love to tell you it's that simple. All you need to do is look for stocks and uptrends and look for a pullback to the 50-day moving average. Sometimes it is that straightforward, and the last 2 years on DVN have essentially been that straightforward, to be honest with you. A lot of energy stocks as well, but other times it gets a little more complicated, right? Look here where it actually found support at the 50-day moving average before it did not, right? And it broke down through the 50-day, broke down through the 200-day moving average. The 50-day moving average is usually thought of as a short-term potential support or resistance level. The 200-day moving average is more significant. So particularly when you find stocks that are breaking down through their 200-day moving average, that means it's given back quite a bit of the recent gains. And in general, a lot of investors would say it's rarely a good idea to be buying stocks below their 200-day moving average, particularly when a downtrend is established. If you look in 2019, DVN was actually in a fairly established downtrend well before the market rolled over in the first quarter of 2020. From there, it took quite some time before DVN got back above the 200-day moving average, and the ideal would be to wait for some sort of break above the 200-day. So if I'm thinking more as a longer-term structural investor, really trying to understand the bigger picture movements, the 200-day and where the price is relative to the 200-day moving average could be a better gauge of that. So we can see we're sort of in line with the 200-day moving average back here. We're well below it for 2019 to 2020. In November, we get back above the 200-day, and overall, we're in a downtrend in the middle of the chart, an uptrend there, and really a sideways trend in the first third. So sideways here, downtrend here, uptrend there. This chart actually combines a number of really interesting takeaways, but also the challenge of using moving average techniques when the market is sideways, right? Moving averages are what you classify as a trend following indicator or a trending indicator, which means it tends to work when a market is trending. When there's a clear downtrend, really good opportunity to use moving averages. When it's a clear uptrend, really good opportunity as well. A sideways trend, a choppy trend, really difficult because the market will actually just mean revert and trade around sideways moving averages. So when the 200-day is sideways, usually means there's an absence of trend. Sloping downwards clearly is a downtrend, and sloping upwards clearly is an uptrend. Here we have the S&P 500 looking at the last 5 years as well. And you can see how since the 2020 low, once we finally regained the 200-day moving average, we often pulled back to the 50-day moving average and usually reverted to the upside. Through much of 2021, it was actually a beautiful, very simple system to identify those pullbacks. But in previous bull market phases, we never really stopped there. You can see that in 2018, in 2019, the 200-day moving average actually was a little better gauge of long-term support. It also shows you how we've had a clear rotation from 2021 of a clear uptrend to 2022 of a clear downtrend. So here at the end of last year, we're above 2 upward sloping moving averages. Now we're below 2 downward sloping moving averages, which is one of the reasons why rallies like we're seeing right now, I tend to be pretty skeptical about, because we still haven't even regained some of those moving average levels. Now, a lot of people actually, and some, it's a little less common because the 50 and 200 are the most commonly used by far, but others use things like the 100-day or other moving average combinations. I put the 100-day moving average in green so you can see how it relates to it, particularly with the S&P 500. I've heard people talk about it a lot because it's tended to line up with the price action. And that brings up a decent point. When you try to answer the question, which one is better, it really depends on your own trading approach, right? If you're a short-term investor, if you're a long-term investor, you might answer that question differently because of the time frame you're trying to operate on. For certain charts, a particular moving average may be more valuable than in others in certain industries. So in things like energy or in technology, the 50-day moving average may be a really good way to identify tactical pullbacks, whereas other things like utilities or real estate, it might not be as valuable. So it is an interesting approach to customize moving averages and find moving average combinations that work for particular charts. I tend to keep things way more simple like that. than that, and just stick with the 50 and 200-day moving average. Here's a chart of Microsoft, and you can see why, in general, it tends to be a pretty decent approach. If you look at the chart of Microsoft over the last 5 years, you can see a number of pullbacks within this secular bull market phase where we've pulled back to the 50-day moving average. And even though at times we've traded below it, we've often resolved to the upside most of the time, right? And so looking for those pullbacks to the 50-day has been a fairly decent approach. There have been a couple times where we've blown right through the 50-day and have gotten down to below the 200-day moving average, once in late 2018, once in early 2020. Both of those, it's been sort of a wait and see mode, right? Be cautious, be skeptical until we get back above the 200-day moving average. And that's been a good early indication that the uptrend is reverting to the upside. So in this case, both the 50 and the 200-day are meaningful. It's just a question of whether you're trying to capture short-term pullbacks or more longer-term pullbacks. So where are we at right now? Well, we're below both of those moving averages. We have not regained the 50-day or the 200-day, which tells me on a chart of Microsoft, we really have to get back above 300 to get any sort of bullish recovery sort of signal using these set of moving averages. Until then, I think you have to keep labeling these sort of bounces like we've seen recently as more bear market rallies. So there you go. I don't know if I really answered the question, which is better, the 50 or the 200, because the answer honestly is it depends. For some shorter term investors, or if you're looking for tactical pullbacks, the 50-day or the 10-week moving average can be a really effective way to identify those short-term pullbacks, particularly within longer term trends. We can use things like the 50-day and the 200-day moving averages as breadth indicators, which we've talked about elsewhere on this channel. You can also look at different ways of measuring trend, not just with simple moving averages, but with other things like exponential moving averages. My market trend model is actually driven by exponential moving averages in particular. I'll put a link in the description below for a video talking about using exponential moving averages to create a market trend model, and also breadth indicators using moving average data as well. For Market Misbehavior, I'm Dave Keller. Stay safe, be well. Talk to you soon.